prices for products and services. What's the usual procedure? What's the usual procedure? When we use the traditional costing technique, for example, our absorption costing technique or our ABC, how do we determine selling price? By using, let's say, absorption costing technique.
Using absorption costing is by determining the sales less the prime cost, and then again we subtract the variable cost to arrive at our profit. Our profit, yeah, for that product.
Okay, so let's say you are trying to produce a new product, yeah, and your manager has asked you to use absorption costing to calculate the selling price of that product. How are you going to go about that, Musa?
You first have to find the total cost of the product itself. That is
okay. What's the composition of the total cost?
That is the prime cost, the sum of all the direct costs plus the variable.
The sum of all the direct plus the variable cost.
Plus the variable, and then you add your desired profit.
And you add your first you determine your total cost, and then you add your profit markup, isn't it? Your desired profit, just like you rightly said. Good. So if you use that to price your products, will it be realistic? Will it be realistic?
Come again?
The technique you have just described now, that is by ascertaining all your variable costs, ascertaining your overheads, putting them together to get your total cost, and adding your profit markup on it to give you a selling price. If you use that selling price to sell your products, what I'm asking is, will it be realistic? Will it take cognizant of what happens in the market, what your competitors are selling their products in the market? Will it recognize that?
No, it will not be that realistic, because maybe your cost of production is higher than even the selling price in the market. So you might be charging a higher selling price than the one existing in the market.
Okay, and if you charge a higher selling price than what is obtained in the market, what are you doing to yourself? What are you doing to your business?
Oh, obviously, you won't make much sales because consumers will prefer a lower price.
Especially in the third world countries. So in a sense, you're not going to make business. You're not going to make business. Excellent. So this nicely takes us to our topic. Target costing is a different costing approach to what we have just explained here. What we have just explained here is the costing technique using.
Oh, yeah, okay.
Yeah, Maria, go ahead. Yeah, go ahead. Okay, so what I'm trying to say is, if you use.
No, I was about to. Okay.
Yeah, okay, go ahead, Maria. Go ahead.
Hello, Mr. Kogan. I was just saying about the price. If you go to third world countries, maybe you will not sell, but for the West world, they will rather go in for quality. But for the third world countries, you as a businessman, it will not work, because the higher price, they don't look for
those quality depends on price. Sometimes they're not that related. Sometimes you could have products that are very expensive, but then they're inferior when it comes to quality. That's sometimes the case. Even though in a lot of cases also you could have how to call it, products that are expensive, which of course has made the required quality, stuff like that. But actually, what we're talking is this is all about making sales. This is all about boosting your business profit. That's what target costing is all about. Because at the end of the day, why are we producing? We are producing because we want to make sales. Simple. So, and why are you doing your costing? You're doing your costing because you want to price your products. One of the most important benefits of costing is for pricing purposes. You have to know your cost before you can determine your selling price. Okay, so in traditional costing techniques, or even in ABC, we always look out for our variable cost, our prime cost, we add our overheads, and we top it up with our desired profit, and we charge that as our selling price. So this is deficient in a lot of ways. The most important way, of course, is it does not recognize what prevails at the market. Okay? It does not recognize, it does not give you a true selling price, you know, especially when you compare yourself to your competitors. You understand? So this is why target costing is the other way around. Target costing, you start by first doing a market research. Okay, you do a market research to know what selling price your competitors or the people you are in the same market with, the people you, the product you try to produce, what the orders already that are in the market, what price they are charging. So you look out for that. You do a market research to determine an average selling price. So now you'll have a clue of what you're going to charge your products. That's the selling price for your products. So after doing a market research, what do? You determine your selling price. And then now you have to, how to call it, deduct your profit. Your profit will depend on your company's policy when it comes to profitability, because some organizations say 10%, 5%, and stuff like that, or some, they have various ways of determining how to call it profits. So when you knock off your profit from your selling price, now you are left with what? You are left with how to call it, your cost. And that cost is called your target cost. So that means this is the cost you are going to target in order to produce your products. If you go above that target, you'll be in trouble. That means you're going to sell more. And if you sell more, there's a likelihood that your products will not be famous. They will not be attractive in the market. So have you got the glue? Okay, so let's look at so just like I explained, when you look at the traditional costing techniques, this is what we do. We calculate our unit cost first. So our unit cost composed of variable cost and overhead, isn't it? Then we add our profit. That will determine our selling price. So the problems with that, the most important problem, the most, how to call it, crucial problem is this price, this selling price does not consider what happens in the market. It does not consider the market price of similar products. Okay? And of course, costs are not challenged. So target costing, we have various definitions, as you can see here. According to CIMA, that's Chartered Institute of Management Accountants, they define target costing as a product cost estimate derived from competitive market price. So you see, in any case, it has to be, the target cost has to be, it has to derive from competitive market price. Competitive market price means when you look at market price, different market prices of your competitors. Okay, so target cost is not just a method of costing, but rather a management technique wherein prices are determined by market conditions. It's a very, very, very efficient way of costing. Okay, so target cost will always be the selling price less the profit margin, because you always start by determining your selling price. Unless your profit, like I said, will depend on your company's policy as to the way you make profits. Is that clear, everyone? Is that clear?
Yes, sir.
Yes, sir.
Okay, good, good, good. So let's look at the steps that we undergo when we are doing target costing. First, of course, we did price, like I explained. So you go around, if you want to produce soap, okay, so you go around the market and look at various soap types, what's their price, you jot them down, you go around various types, you get at least a fair number of different competitors, their prices, and then you try to find an average price. So that's what you do when you're trying to determine a possible selling price. So you do a market research. So, and then two, you establish the required profit. That one is simple. Since you've already done a market research, you found out your average profit. So the next thing you need to know is, what is my organization's profit policy? Does it mean that we do a 10%, a 5%, or whatever? Okay, and whatever that will amount to, you knock it off from your selling price so that you arrive at your cost. Because we know in this equation that total cost, okay, total cost plus profit equals to selling price. So therefore, total cost is equal to selling price minus profit. Simple from the equation. So it's the same thing that you use here, the same concept you use here. Determine your selling price, determine your profit margin, and the difference between the two will be your target cost. So your target cost will be the cost that you're going to target to produce each unit of your product. So once you do that, you don't have any problem with marketing, because already you know what you're going to, how you're going to produce your products, and of course you will be in control as well, so that you know what material should I put there, what materials should I not put there, what kind of labor should I employ in order to produce my product, because you already know how you're going to price your product. Is this clear? Any questions? Any questions? Are you with me?
Yes,
Hello?
sir.
Yes, sir.
Yes, sir. We are with you.
Okay, excellent, excellent, excellent. Good. So we move. Okay. So after calculating your target cost, now what you're going to do is you produce, okay? And of course, you have to lastly calculate the difference between your target cost and your estimated cost. So after calculating your target cost, you should try to calculate your cost ordinarily using your current costing technique, either ABC or absorption costing. Okay, so once you use that, you will always arrive at a total cost. So if that total cost, according to your normal costing technique, for example, the first step, the step we discussed before, when you add your variable cost, when you had your overheads, okay, so whatever cost that total to, you compare that to your target cost. So if that cost, usually that cost will be higher than the target cost. So if that cost is higher than the target cost, then there is a gap. That gap, you need to eliminate it or you need to close it. Okay, for example, if your target cost of producing X soap is $45, but then your estimated cost using your ABC or your absorption costing is $50, there is a $5 gap. Okay, so that gap, you need to eliminate that. So how you eliminate that gap is what we call, what we employ a technique called value engineering. Okay, so but before we go to Google Sheet, like I said, we will just go and look at value engineering, and we go up to the advantage and disadvantage, then we just go and do our questions. Okay, agreed. So now, what is value engineering? value engineering is a systematic method to improve the value of goods or products and services by using an examination of function. Value as defined is the ratio of function to cost. Value can therefore be manipulated by either improving the function or reducing the cost. So value is what customers are ready to pay for. Okay, so that means the benefit of your product is what is called value. So value engineering is a way whereby you're going to improve on your product. So how do you improve on your product? Is by ensuring that your target cost is met. How you reduce your target cost, how you reduce your estimated cost to arrive at your target cost, ensuring that you don't interfere with quality, you don't interfere with value. Okay, that's what you call value engineering. And of course, there are various methods of value engineering. So what you do is you look at the composition of the product. You look at the materials that went into the product. You look at the labor that is employed in order to produce the product. And of course, you look at the processes of the processes that you undergo in order to produce the product. And of course, you look at the specification of the product. So if you're going to do value engineering, you should ensure that the material, for example, if you're using, let's say, 10 kilograms of oil to produce 1 bar of soap, try to see if you can reduce that 10 kilograms to, say, 8 kilograms. But then whatever you do, you must ensure that the quality of your product is not compromised. Okay? So you look at, for example, labor. If you are using, let's say, supervisors or highly skilled labor to run the machines in order to produce your product, of course, naturally, supervisors will be paid more compared to, let's say, officers, or compared to, how to call it, a trained apprentice. Okay, but if you think that those officers or trained apprentices can be able to produce the product efficiently, why do you have to use the supervisors? Because the supervisors will be paid more. So you look at that and try to slice cost, always ensuring that efficiency or quality of the product is not compromised. Okay, is that clear, everyone?
Yes, sir.
Yeah. Okay, so before we answer this question again, so we're going to look at examples of cost reduction or example of closing the cost gap using value engineering. So one example is to reduce the component count. Okay, if you know that you can use 10 pieces, let's say in a situation whereby you want to produce tables, if you're going to use 10 pieces of wood, for example, to produce one table, okay, think of maybe reducing that to, let's say, 9 pieces, okay? Because those 10 pieces, maybe the reason why you're using all that is that the wood you buy is not of quality. So during processing, during the production processes, there are a lot of wastages. So you could improve on the quality of your material to ensure that your waste is minimized. So you look at the component count and then try to reduce it. And of course, if you have to reduce it, naturally you have to improve on the quality. But then whatever you do, you must make sure that quality is not compromised. Or you could replace the material. For example, if the same table, if you're using, let's say, aluminum as your tabletop, let's say aluminum has your tabletop, you could say that if I replace this with plywood, is it going to affect the taste from my customers? Are my customers, if that is the case, if it will not affect the quality of your, so you could think of replacing with plywood, because plywood generally is likely to cost less compared to aluminum topping. Okay, so the second example is using production capacity. Okay, if a production process is very complex, there are lots of procedures to follow. It will obviously make the production cost higher, because if there are lots of steps to follow, that means every step will how to call it, will require some cost, and that's going to make your production process very, very expensive. So you have to reduce production complexity. You have to cut out non-value added activities. If there are activities that will not increase any value on the product, you slice them off. Okay, so another way of reducing the cost gap by using VE, value engineering, is to revise the production process. Okay, is to revise specification as well. So you can look at the specification of your products and then try to see if there are things there that won't, improve the quality of the product or will not make any difference. You slice them off from your specification. So these are some of the procedures that we use in value engineering. Are we communicating?
Yes, sir, we are communicating.
Okay, so do you understand value engineering?
Yes, sir.
Yes, we understand.
Kadi Jaite, tell us, what is value engineering?
Hello?
Yes, Kadi, are you with us?
Yes, I'm with you guys.
Okay, what is value engineering, Kadi?
Value engineer is to reduce the production complexity.
Okay, that's one way of value engineering, but what is value engineering itself?
It's a value engineering.
Well, you've given one example, fine, but I want the definition. Who can help me? Musa?
Yes, sir. Value engineering is a technique of reducing the cost of production without compromising the quality of our product.
Okay, good. That's a good one. Senabu Dumbuya, are you with us? Senabu? Senabu Dumbuya?
Yes.
Yes, tell us about value. What is your understanding of value engineering, Senabu?
It's the method to improve the value of the good, product or services by using an examination of functions.
Examination of functions and the materials and everything. Okay, good. That's not a bad definition. Okay, excellent. So I'm happy that you have a gist of what we're going to do. Okay, so let's look at some advantages of target costing, right? Let's look at some advantages of target costing. So the first advantage is cost reduction and control. Okay, because you are in control of what goes into your production and what doesn't go in there, so you are able to reduce cost, at any particular point in time. So that's one very important advantage. Market-based costing. Selling price considers what customer might want to pay for the product. So your costing will depend on what prevails at the market, because your costing reflects your selling price. So you start by determining your selling price and then ensuring that whatever target cost you produce is based on the selling price. Okay, so your customer requirements for quality, cost, and time are incorporated into product and process, because before, in fact, you start producing, you've already done a research, and during the research of determining the selling price, it's not only the selling price that you determine, but you can ask customers what they like with the product and what they expect to see in the product. Okay, and then the design, the cost control is emphasized at the design stage. So any engineering charges must happen before the production starts. So you start controlling your cost from the very design stage. Okay, so if you're designing, you will not want to include some techniques that are non-value adding. Okay. So we move. Some disadvantages, okay? Of course, in life, if there are advantages, there must be disadvantages one way or the other. So it takes more time, of course, because it involves research. It will take a lot of time, and it will be costly also, because during research, you have to do visits, you have to take samples, you have to analyze, you know, so all those things cost, how to call it, money. So that's the most important disadvantage. But overall, it is a very, 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 in fact, it is the best way to employ if you want to produce and make profit out of your business, because whatever selling price you are charging, you've already determined that from onset. Okay, so what we're going to do is we're going to go back and do our questions. We're going to go back and do our questions. The first question we have is this one, okay? So, but before we do that, I want to show you how to start Google Sheet. Okay, so first, in order to start Google Sheet, you need a Gmail account. Okay, you need a Gmail account. And if you don't have a private Gmail account, your Gmail that is given by the UTG is already a Gmail account. Okay, the email account that UTG gives you is already a Gmail account. Okay, so take note of that. So you could use that. So go to your Gmail account, either your UTG one or your private one. Are you with me? Hello?
Yes, we are here,
Hello?
chef.
Yes, we are with you. Are we going to minimize this one and then open another one?
Okay, you're using your what are you using? Your laptop or?
Yes, I'm using the laptop.
Okay, right. You could do them in the background. You could open another. You could